In today's video I will try to answer a question that seems to be the general concern of many aspiring traders, especially those who end up discovering this channel and finding out that technical analysis is much deeper than they previously imagined. The question is whether or not forex trading is hard. There is an important distinction that many traders fail to make, which is to differentiate what's difficult from what's complicated, because these two are not the same thing. Often when people start to get in touch with the necessary level of analysis depth to trade consistently in the markets, they start to get overwhelmed with how complicated things can get on a chart. However, this overwhelming sensation has two different sources. One is obviously the difficulty of the analysis, but the other is the ingrained notion that traders have that they must be correct all the time. If you combine these two things, you get an explosive combination. If you are a trader that thinks like that, please know that the first thing you should change is the idea that you must be correct all the time to make money. In fact, I already pointed out several times that you can, and you probably only will make money in the long term being wrong most of the time. The reason for that is a fine equilibrium between the properties of risk-reward ratios, the idea of trade location, expectancy, and the margins of error that are inherently attached to various levels of risk-reward. Here is the main picture. If you want to make money in the long term, you must expect to win more than what you risk. That's an obvious practical necessity. For that to happen, you must have a risk-reward level that is greater than 1:1. However, risk-reward ratios that are larger than 1 are naturally losing games. It's much easier for the market to hit your stop-loss than your profit target order, for the simple reason that the stop is much closer to the entry than the target. The way to counteract that is by employing the idea of trade location, which is the attempt to get as close as possible to the reversal points of the market. This is the problem that advanced technical analysis tries to solve. That is hard for many different reasons, but it's completely achievable. The fact is that in professional trading, we are always trying to be very precise, and that naturally produces errors and losing trades, but traders fail to realize that the only alternative to this situation is a lot worse. If you try to trade without this finely calibrated framework I just described, you will be going in the wrong direction mathematically, statistically, and pragmatically speaking. You will not have any helpful margins of error, you will not have an expectancy level higher than 1, and you will most likely be trading in the middle of nowhere in the charts instead of near the edges of the market. Going back to the distinction I wanted to make in the beginning of the video, something complex does not necessarily mean it's difficult all the time. Imagine the following situation. Imagine that you have access to all sorts of advanced tools of technical analysis, risk management, and trading psychology. You will find yourself trying to trade near the edges of the market, and that's kind of difficult, but it's not rocket science either. The natural consequence of the operational framework I described to you is that you will have a lower win rate, but you will be able to make money being wrong quite a lot. In that sense, risk management acts as an antidote to the overwhelming complexity of technical analysis. If you are a trader who is mature enough to understand that, you will feel great because you will have the luxury of being wrong a lot and still make money. That's not as cool as the idea of being right all the time, but it's the only realistic idea. Now imagine that you are the scalper trader who is possessed by hyperbolic discounting, and you feel that you absolutely must be correct in all your trades, otherwise you will fail. If you are in that kind of mental state, the only real ally you have is your luck, and it will eventually run out. It's funny to notice that this hyper-performance scalping paradigm is actually a lot more difficult than trading with the healthy framework I try to teach in my courses. Here's a summary of the situation. Let's see which one of them is truly the most difficult one. You can try to employ a complex analysis and have the luxury to be wrong most of the time and still make money, which relieves an enormous amount of psychological pressure. The only other alternative is applying a simple analysis that will enable you to be right almost all the time, but there are two major problems here. The first is that you will have to live with the pressure of actually being right all the time, which is not exactly helpful or comfortable. The second problem, and perhaps the more serious one, is that to assume your simple analysis actually works, you must assume that your simple solution to the market has an extraordinarily high explanatory power about price action, which is probably not the case. The application of a simple analysis usually comes from being lazy, not from the fact that you have a tool that is too powerful. If we analyze these two situations in context, only one of them allows you to trade consistently in the long term, and it happens to be the one who produces the least amount of psychological pressure. If that's not a blessing, I don't know what is. The caveat of course is that the analysis is complex and all of that, but in this case that we are analyzing, a complex analysis is the only possible way of achieving success. The other alternative is of extremely simplistic application, but it's way harder to sustain in the long term than the complex alternative. Basically, you have two choices. A moderately difficult and logical approach that will be able to sustain you through whatever the market can throw at you. The alternative is a naively simplistic approach that feels good in the short term, but it's deadly in the long term. To close the point I'm trying to make in this video, complexity is not the same thing as difficulty, and simplicity is not the same thing as ease. Hopefully you will be able to understand that something can be complex and relatively easy simultaneously, and that something can be simple and extremely difficult if not impossible. I will repeat the essential point once again. By facing complexity, you are actually making your life easier. By forcing a simple solution, you are actually making your life harder. It should be obvious which one you should choose. If you liked this video, don't forget to support us by clicking the like button, subscribing to the channel, and leaving your comment below. Thank you for watching.